What if debt was never meant to be repaid? What if the system you were taught to trust, work hard, borrow responsibly, pay it back, was quietly designed so repayment is mathematically impossible for most people? Not because you failed, not because you're irresponsible, but because the rules were written that way from the beginning. Here's the mystery that almost no one is encouraged to ask every year. Individuals work longer hours, governments collect more taxes, corporations post record profits, yet total global debt keeps rising. It's not shrinking, rising. If debt is truly being paid back, why does it never disappear? To understand this, we have to stop thinking about debt as a personal mistake and start seeing it as a system, a structure, a design. Because once you see how it was built, you realize something unsettling. Debt isn't just a burden. It's a mechanism that quietly converts human labor into permanent obligation. For most of human history, debt existed, but it was limited. Ancient societies understood that unchecked debt could destroy entire civilizations. In Mesopotamia, rulers periodically declared debt jubilees, wiping the slate clean so farmers wouldn't be enslaved forever. In biblical traditions, debts were forgiven every 50 years. In medieval Europe, charging interest was often viewed as immoral, even sinful. Why such extreme measures? Because early societies recognized a dangerous truth. When debt compounds without limits, it doesn't just extract money, it extracts freedom. The debtor loses future choices. Their labor no longer belongs fully to them. Left unchecked, debt turns free people into servants. But as empires expanded and economies grew more complex, rulers faced a problem. Armies, infrastructure, and wars required enormous resources. Taxes alone weren't enough. Borrowing became the solution. And those who could lend, bankers, financiers, and later entire financial institutions, discovered something revolutionary. Debt could enforce obedience without force. No chains, no guards, just math. The real shift came when money itself changed. Goldsmiths in Europe noticed that depositors rarely withdrew all their gold at once, so they issued more paper claims than gold they actually held. Those extra claims were loaned out, earning interest. This practice, fractional reserve banking, quietly transformed money from a store of value into a promise backed by debt. At first, it seemed brilliant. Economic activity increased, trade expanded, wealth appeared to grow. But hidden inside the system was a fatal flaw. Money was now created as debt. Every new unit of currency entered circulation with interest attached, which meant more money had to be paid back than actually existed. From the very beginning, someone had to lose. Defaults weren't a sign of irresponsibility, they were inevitable. When central banks emerged, this model became official. Governments borrowed from banking systems. Banks created money by issuing loans. Citizens borrowed to survive and advance. Corporations borrowed to grow. Entire nations became locked into cycles of refinancing old debt with new debt. Debt wasn't a side effect of the system anymore. It was the system. In the 20th century, the model exploded. After massive wars, governments were drowning in obligations. Instead of dismantling the debt structure, they expanded it. Consumer credit was normalized. Mortgages turned homes into financial instruments. Education became something you purchased with decades of future income. Every stage of life was now tied to borrowing. Want an education? Go into debt. Want a home? Go into debt. Want healthcare? Go into debt. Go into debt. Go into debt. The brilliance of the system wasn't cruelty. It was normalization. Debt stopped being something you avoided. It became something responsible adults were expected to carry. But beneath the surface, a silent shift occurred. As debt rose faster than wages, people adjusted by working more. Dual-income households became necessary. Retirement was delayed. Job loyalty replaced freedom. Risk-taking increased, not because people wanted luxury, but because standing still meant falling behind. Debt began shaping behavior, not through laws, but through pressure. Eventually, every debt-based system reaches a breaking point. For individuals, it looks like burnout, anxiety, and default. For societies, it looks like financial crises. It's the Great Depression, the Latin American debt crisis, it's the Asian financial collapse, it's the global crash of 2008. Each time, the pattern is the same. Credit expands. Asset prices rise. Wages stagnate. Debt piles up, then something snaps. And yet after every collapse, the system survives. Banks are rescued. Interest rates are slashed. Governments print more money, new debt to fix the damage caused by excessive debt. Losses are transferred to the public. Profits remain private. Ordinary people are told this is necessary to save the economy, but the structure itself is never questioned.
Ow.
Modern debt doesn't require prisons or whips. It only requires schedules. Monthly payments, credit scores, it's automatic deductions, it's compound interest. A person may never miss a payment in their life and still remain trapped, because interest slows progress, inflation erodes income, emergencies force new borrowing, and wages rarely keep pace with asset prices. This creates a condition where people are never free, only temporarily stable. You don't fully own your future labor. It's already promised. You don't choose freely. You choose between obligations. It's the most effective part of all. People blame themselves. Governments propose fixes, interest caps, stimulus checks, partial debt forgiveness, loan restructuring. But these solutions avoid the real issue, treat symptoms while preserving the cause. As long as money is created as interest-bearing debt, inequality expands. Wealth concentrates, crises repeat. Even reforms often strengthen the system by stabilizing it, ensuring it can continue operating rather than forcing a rethink. The question almost never asked is simple but dangerous. What if money didn't have to be born as debt? Today, global debt is more than 3 times the total economic output of the planet. Student debt delays families. Housing debt locks generations into permanent leverage. National debt justifies cutting public services while protecting financial institutions. Digital finance hasn't changed the rules. It's accelerated them. By dash now, dash pay, dash later. Invisible algorithms. Instant credit. Faster chains. They're lighter than before, but they're everywhere. So what does this story actually tell us? First, debt is not just an economic tool. It's a system of control, obedience, and risk far more than laws ever could. Second, financial crises are not accidents. They're built-in outcomes of a system that requires endless expansion to survive. Third, real reform doesn't start with budgeting advice or discipline. It starts by questioning how money itself is created. And here's the final question history keeps asking, one we keep avoiding. If a system requires endless growth, endless debt, and endless labor to function, what happens when growth stops? And what happens to the people still trapped inside it? If this changed how you see money, debt, and freedom, share this video. These conversations don't spread on their own. Subscribe for deeper explorations into hidden financial systems, power structures, and the stories behind the numbers. And before your next payment is due, ask yourself one thing. Are you using debt, or is debt using you?